Let's get some instant reaction right now. Francis Donald, Chief Economist at Manulife, joining us. You've been listening to some of the commentary we've heard so far this morning. What's your immediate reaction?
Governor Poloz is stalling, and he's stalling as long as he possibly can. Let's remember, while the rest of the world is cutting rates, there are downsides to cutting rates in Canada as well. Governor Poloz not wanting to inflame existing imbalances here, and his references to the housing market, which, Amber, you're pointing out, that's the key to this statement. What is he telling us? He's telling us that mortgage rates are low. Why? Because Canada has been importing lower rates from the rest of the world, and as a result, housing, our interest rate sensitive sector, is actually reaccelerating. What that says to me is the Bank of Canada doesn't feel it needs to cut right now. The Bank of Canada doesn't have to do its own dirty work. It is getting lower rates from the rest of the world. It can stay on hold.
Now, business investment is something that they call out explicitly, saying that it contracted sharply after a strong first quarter amid heightened trade uncertainty. And they go one step further, saying given the composition of growth, the bank actually expects economic activity to slow in the second half of the year. So even though they conclude saying the degree of monetary stimulus right now remains appropriate, the fact that they expect that to slow or signal that that is a deterioration, is that a showing of hands at all?
Yes, and let's make no mistake, the Bank of Canada is stalling, but it will eventually be peer pressured into interest rate cuts. It knows it, we knows it, every economist on the street knows it. At this point, what they're going to have to contend with is whether or not business investment collapses off of the back of a weaker U.S. economy or just trade tensions at large. And the degree to which business investment slows and how that translates into perhaps hiring is going to determine the exact timing of when we see this next cut.
If we look at the domestic economy, and we talked about how strong the second quarter was, although they're suggesting that's not necessarily the case going forward, but this idea of easy money already existing in this country. What message are they sending about the fear they might have in lowering rates right now when generally speaking, rates are already low and obviously we love our debt in this country and we're holding a lot of it right now?
Well, Governor Poloz and many officials at the Bank of Canada will be quick to, I expect tomorrow and over the next few weeks, remind us that the interest rates in Canada are lower, both in nominal and in real inflation-adjusted terms here than where they are in the United States. So Governor Poloz can make the case we don't have to ease because we didn't go too high in the first place. But let's also remember, and CIBC Ian Pollock had a note this morning saying 65% of the bond market moves that we see in Canada are being imported from global yields. That essentially says the Bank of Canada is already seeing lower interest rates here. It doesn't actually have to inflame imbalances in our domestic economy further in order to benefit from a lower rate environment. This is one of the few times when being an economy very exposed to the rest of the world is actually benefiting us.
How do those dynamics work? Because some will say that it's the bond market that is actually going to force the move, and central banks, whether it's in the United States or Canada, when you look at things like yield curve inversions, you'll need to see the central bank step in to try and steepen that curve.
Well, isn't it miraculous that Bank of Canada, of all global central banks, has managed to really send the message to markets that it isn't a slave to markets, that it isn't going to react to bond markets. And probably in this case, the Bank of Canada could cut 25, maybe even 50 basis points over the next year, and the damage done to that flat and inverted yield curve would not be entirely undone. What we need to see at this point for the yield curve to re-steepen in Canada is a re-steepening of that U.S. yield curve, which is why it's entirely possible to have a forecast that shows you the Fed cutting 50 basis points and the Bank of Canada doing nothing.
If you're just joining us, the Bank of Canada with its latest interest rate decision, keeping rates on hold, 1.75%, even with some of those global uncertainties we talk about every day here on BNN Bloomberg. Francis Donald, head of macro research and chief economist at Manulife Investment Management, joining us in studio. Let's talk about one of the other potential pressures for the Bank of Canada, and that's the currency market. I alluded to the fact that immediately you saw a little lift in the loonie against the U.S. dollar as the Bank of Canada, in your words, stalling a little bit here. Stephen Poloz knows the export market. He used to run export development Canada. What's the wiggle room if, to your point, the Fed starts cutting rates, we stay on hold, the Canadian dollar strengthens a little bit? Seems like there's central banks everywhere who would like to see their own currencies a little bit weaker to help the export picture. What kind of rope do you think the central bank in this country has on that front?
Well, another piece of good news for the Bank of Canada is that even though the Bank of Canada is one of, if not the most hawkish central bank in the G20, our currency has actually weakened. In part, that's because of a strong U.S. dollar, the search for yield into the United States, rates is also because of slightly weaker oil. So there's not a lot of pressure right now in order to cut to provide some weakness to the currency. You couldn't ask for a better situation when it comes to wanting to keep rates on hold, but still having some wiggle room on the currency. Now, when I say eventually the Bank of Canada will be peer pressured into cutting rates, it is because we do expect that U.S. dollar strength to kind of mollify to a certain extent, and they'll want to keep financial conditions loose here. So too hawkish, you tighten financial conditions, you work against some of the benefits that have flowed through into this country.
Now, they say that they're going to, continue to monitor incoming data, but pay particular attention to global developments as it impacts Canadian growth and inflation. That's kind of the last sentence there. And this seems to be a shift that's taking place among global central banks, where initially they were telling us to be data dependent, and that's going to be govern the next moves. Now we have this new verbiage, risk management, and taking out rate cuts as an insurance. Do you think the Bank of Canada has fully made that tilt?
They probably haven't made that tilt, and it's because they will make that tilt in October. That's when they go through their full forecast adjustment. The entire institution bands together. They release their monetary policy report. They have a lot of information to process over the next month or two. And what's so fascinating about this end sentence that you're alluding to is that last time we heard from the Bank of Canada, they talked about monitoring trade conflicts. Now they've modified that to global developments, which probably also means Hong Kong protests, Argentinian debt, Brexit. These are all issues that are going to develop. Now, what's critical is that do Brexit or Hong Kong protests necessarily directly affect the Canadian economy? Maybe, maybe not. What does matter if we see a global slowdown, a U.S. slowdown, we will feel the indirect effects of all of these global developments.
So I hear you saying that even though the Bank of Canada didn't cut rates this time, and they didn't really show their cards in the statement, and the Canadian dollar is rallying because maybe the statement is a little bit more hawkish than they thought, your fundamental view of what the Bank of Canada is going to have to do doesn't change. You're still expecting rate cuts, and you haven't materially altered the pace of those cuts.
That's correct. So we are still expecting 2 to 3 rate cuts to occur over the next year, but we're a touch more hawkish than the street because we don't expect them to happen until Q4 of this year and potentially into 2020. That's because we do believe that the Bank of Canada is focused on the downside risks of cutting much more so than other major central banks. They will put it off as long as possible. They do not want Canada's debt situation to get worse. They're probably also cognizant of some of the messaging that might be sending to markets. For me, the big pivot that'll be critical is whether or not they cut in October. I don't think so, but it's a long time between now and the October rate decision.
What would be the big wild card there? Is it the trade story? I mean, no one can know when the trade issues are resolved. Have you forecast when that will happen when you're trying to determine where the Canadian economy is a couple of years from now?
No, I like to sleep at night, so I don't try to forecast where the trade conflict is heading next. But of course, it is a key input into what's happening. It is a continuous external exogenous shock that we need to monitor. What the Bank of Canada will need in order to make that October decision is their forecast for U.S. growth. If U.S. growth is going to head into a recession or close to that territory, the Bank of Canada is going to want to provide some assurance in advance. The other thing I'd mention is if the Fed does move, for example, 50 basis points in September, that's not the consensus call, but if they did and they suggested more rate cuts ahead, the Bank of Canada might want to say the divergence is getting a little bit too big for us. Lots of information to process in the next 6 weeks.